Why are investors suddenly so nervous? And what does it mean when Wall Street's fear gauge surges to its highest level since spring? In the next few minutes, you'll find out exactly what this spike signals, why it's happening now, and what everyday investors like you should be watching for next. Let's jump right in. The so-called fear gauge is actually the VIX, short for the CBOE Volatility Index. It tracks how much traders expect the stock market to swing over the next 30 days. Think of it as a real-time barometer of market anxiety. When the VX is low, investors are feeling calm. But when it jumps, it means uncertainty or even fear is on the rise. After a summer where the markets barely budged, the VIX just soared to its highest level since May. That's a big deal. So what's changed? The main culprit, renewed tensions between the US and China. Investors are worried that a trade standoff between the world's two largest economies could escalate, and that's injecting fresh uncertainty into the markets. And to give you some context, all summer long, the stock market enjoyed one of its calmest stretches in years. The S&P 500 barely moved, and the VIX hovered near historic lows. But markets can change fast. News of trade friction has reignited fears that global supply chains could get disrupted, corporate profits might take a hit, and economic growth could slow down. When investors get spooked by these headlines, they often rush to buy options that protect their portfolios. That demand drives up the VIX. It's not just about nerves. It's about hedging against the risk of bigger market swings ahead. Now, here's an interesting angle. Spikes in the VX don't always mean a crash is coming. Sometimes they're more about traders bracing for turbulence, not necessarily predicting disaster. In fact, short bursts of volatility are a normal part of the market cycle. But when the VIX surges sharply, it's a clear sign that uncertainty is in the driver's seat. Let's look at some history. Back in March 2020, at the height of pandemic panic, the VIX rocketed above 80, levels we hadn't seen since the 2008 financial crisis. Right now, we're nowhere near those extremes. But this latest jump is a reminder. Markets can go from calm to chaotic overnight. So what should regular investors do with this information? First, don't panic. Volatility is a fact of life in investing. Instead of making knee-jerk moves, use this time to review your portfolio. Are you diversified? Do your investments match your risk tolerance? Sometimes, these moments of market stress are a good reminder to check in with your long-term plan. Also, keep an eye on the headlines. If the US-China standoff escalates, we could see more market swings. But remember, markets have weathered trade wars and political drama before. Often after a spike in fear, calm eventually returns. If you found this breakdown helpful, make sure to hit like, drop your thoughts in the comments, and subscribe for more clear, no-nonsense market insights. And as we watch the fear gauge together, remember, uncertainty is part of the game, but knowledge is your best defense. Stay curious and stay invested.